Thank you everyone for joining us this evening. We're excited to have you here for tonight's session on retirement tax planning with Beau. Just a quick couple notes before we dive in. This webinar is being recorded and we will be sending out a link with this recording to rewatch and share it with anyone who you guys think might benefit from this webinar. Throughout the presentation, feel free to drop your questions again and any comments or thoughts, as Beau will address them at the end. We will also be giving out a free gift at the end of the webinar, so please stay tuned. It is my pleasure to introduce Beau. He is a Wall Street Journal and USA Today best-selling author who just released the Social Security Clarity book. Please go ahead and take it away, Beau.
Oh, I was modeling the book I didn't know you were finished. Welcome everybody. I'm excited to talk about something I've been talking about all day actually with clients, and that is proactive tax planning and the importance of that in the context of retirement planning. So if we kind of go through, let me click through here. So before we start, one of the things Anna mentioned, there's an engagement gift. So this is interactive. So I would love to hear from you who's calling or who's watching the webinar, where you're watching from, right? If you're local here, North Georgia, have some of you out of state, would love to see who's here and where you're from. We're going to do an engagement prize. This is a resource that we use all the time in our office. This is a mentor and resource for me for a long time, Ed Slott. So we're going to talk about retirement tax planning tonight. If you're in the weeds person, want to get into big detail, this is a 400-page book digging deeper. So I have this for somebody. So ask your questions. Again, let me know what your big concern is, what the questions are, and first off, just start off, who's here, where are you from? And let's dig into this because we talk about retirement planning. And I want to start with making sure we make a clear distinction between financial planning and retirement planning before we get into this tax conversation. Something I have a viewpoint that's a little different because I see hundreds and hundreds of families and households and people coming into this transition and these things we approach when we come to retirement. And it's become very clear to me is that there's really segmented advice when it comes to financial planning. And not wrong or bad, it's just what it is, and it's being aware of it. And the first thing I'm describing is there's a lot of investment advisors out there that are really structured to help you accumulate assets. And we'll talk about that a little bit more too, is okay, when do we accumulate assets? That's our job really as we get to that window to start preparing for retirement. When we get to talking about retirement planning, we can't just talk about building assets to work with. We have to start integrating the 5 key components. And you'll hear me talk about this all the time. It is a written income plan that includes optimizing your Social Security, how you distribute your assets from when and where in the timeline, a risk management plan with your assets, your investments, how are they structured? Are they appropriate? A tax plan, which we're talking about tonight, unplanned medical expenses, long-term care. We talked about the unplanned medical expenses, tax planning, and the E in our route to a successful retirement is estate planning. Are those documents buttoned up? Do we know that our wishes are going to be carried out? That is where we need to focus. And one of the key areas that's going to move the needle the most, unfortunately, most people don't do this, right, is tax planning, proactive every year tax planning. And what I would love to have you wire your mind to is that every year I'm not going to let a 12/31 of the year go by without me taking advantage of any opportunity to convert money at a lower tax bracket or see what the opportunities are to shift assets to put myself in a better position to pay less tax over the course of my life, right? And who is this for tonight? This is for anybody that likes keeping more of their money or is a fan of not sending more than they have to the government. Okay, is that everybody? Thumbs up? All right, let's go. Again, let me know let's engage. Let me know what you're thinking, what questions you have. And that's a really good book from Ed Slott here. Let's talk about tax traps that come up in retirement. One that applies to the majority of households that we come across is IRAs. Now, IRAs, 401ks, they were great vehicles for us to accumulate assets. That's what our companies in a lot of cases had. for us to grow and build wealth, build assets to work with. But if you look at this, I think this is the way we need to start thinking about our IRAs. And it's even worse since the Secure Act in 2020, how these are treated and how the tax is handled. But your IRA is simply an IOU to the IRS, meaning it's a tax bill. And I had a conversation earlier today about, but I get a deduction with my IRA, but I get a deduction with my 401k. I want to be clear. It's not a deduction, it's a deferral, meaning we are growing taxes and going to pay a higher tax on a higher amount of money sometime in the future. So our IRAs are the worst tax money we have. So what can we do about it? Because a lot of time in retirement planning, we're coming to that phase of life with buckets of pre-tax money, sometimes big buckets of pre-tax money. And what do we do? How can we address it? Let me kind of show you a little bit about, we talk about how to conceptualize this and how to really think about this. Say you built $500,000 in an IRA. Could have been a 401k that you transferred to an IRA, but it's in your pre-tax IRA now. Now, do you have $500,000? Well, I've had people argue with me, and I've even pushed back to say that IRA is a joint account because the joint owner in that is Uncle Sam or the federal government. Right? And if you just look at this, if I have a $500,000 IRA and I have here you go, look at this. If I am a 24% tax rate, I really only have an asset of $380,000 because the other 24% is spoken for, right? Accounted for. If I'm in a 35% tax rate, little higher income situation, I really only have $325,000 of the 500. So it's really important to see what do I actually have in the IRA, and we need to net out the bill that's due to the partner in that account because sometimes we get caught up on paying the tax to get this to a better tax vehicle, the Roth IRA. But let's think about this. If I'm in the 24% tax bracket, as in this example, and I really have $380,000 that is really mine, my asset in that IRA. If I convert it to a Roth, I'm going to pay that same 24% tax, and I'm going to have the same $380,000 now in the Roth IRA. What is the difference, though? Bonus question. What's the difference? Now my $380,000, instead of growing in a forever tax vehicle where it's going to be growing bigger and taxed higher in the future, I have this $380,000 now in a position to grow tax-free forever, right? So again, it's the same. You have the same money. You're just putting it in a better position moving forward when we do conversions. And we really need to look consistently at the opportunity to do that. And we're going to talk more about that here in a minute. And this is another reason a lot of you here tonight, you're in this window, maybe mid 50s, early 60s, mid 60s, but you have a window between where you are now and 73 to 75 to where if we have this money in these pre-tax accounts, you're going to be required to take required minimum distributions, and you're going to have to take money out of these accounts. Now, what happens and what sneaks up on people if they don't do this tactical Roth conversion strategy we're going to explain here and lay out is the timeline gets shorter every year. That's why I said don't let 12/31 of a year go by where you didn't at least do the analysis to see is there an opportunity for me to take advantage of a lower tax bracket and get money shifted into a better position. So if it grows and the timeline shrinks, what can happen, and there's a lot of that covered in the Ed Slott book that I shared, is you're forced to take money, and you still have Social Security for most people. You might have pensions. You have other fixed sources of income. And that required piece you're required to take from these big IRAs that weren't dealt with earlier forces you in forever penalties. You're paying higher taxes on your Medicare surcharges. It can be bumping you into thresholds you don't want to be in, and you're paying tax on money you don't need. And it sneaks up on a lot of people. That's why you'll hear me say this Roth conversion strategy is like chopping down a tree. If we get busy with life, which is human nature to do, and let 3 years, 5 years, 10 years go by, it'll go by like that. But if every year we say, it's my priority, it's my objective, I know the benefits of doing this, and I say, what is the opportunity this year? And it might be a $20,000 conversion. It might be a $100,000, whatever the opportunity is, and you do it year by year where it makes sense as a smart conversion. Right? What keeps us within the tax bracket? What keeps us below penalties for maybe the surcharges on the Medicare? And you're looking at that every single year. And if you'll do that work, for many of the households we work with, it's hundreds of thousands of dollars in extra money that you get to use and spend. I had two cases today. One, it was an additional over $1 million, and one was over $2 million by doing the Roth conversion strategy and the timeline. So we'll talk more about that as we go through. We're going to talk about the tactical Roth conversion, because it applies again to most households more than any other tax strategy. This should be a part of the annual conversation. Some other hidden tax traps, and a big one that we need to talk about for you couples out there is, let's talk through the importance of taxes and tax planning for when a spouse dies, because there's a 100% chance that's going to happen. We're going to die one day. So the big question I like to ask is, what is the plan for when we die, or when one of you dies? And usually what I run into is the normal scenario is we haven't got around to it yet. Don't think about these things. But I want to talk and bring some awareness to what happens. And for many people today, that might be the action item we walk away from, is maybe we should have some of these conversations to make sure that when one of us dies, the other one is solid. There's a plan, there's a contingency, and we're not leaving a vulnerable surviving spouse with less options to solve the problems they're going to be dealing with. And then the third thing is just other things that come up most often in tax planning that can save taxes. Again, these are things that could be helpful if you're the person that doesn't want to pay more money to the government than you have to. So now this conversation came up recently when we were laying out the setup of a retirement strategy. And it's this concept of asset location. And there's some tax ramifications here. So a lot of times we hear the conversation around asset allocation, and that's our ratio of fixed income to equities, market growth to safe money, right? So it might be a 60-40, 80-20, 70-30 asset allocation. A thing that's not really dealt with and talked about near as much as asset location. Right? So what we're talking about with asset location is it does matter where specific kinds of assets are in the timeline if we're looking for an optimized result. And when I talk about an optimized result, I'm talking about you and your family getting to use and spend as much of your money as possible. And if we look at this timeline here, from least efficient to most tax efficient, we're talking about your assets. Your least efficient assets are going to be your taxable assets, savings accounts, CDs. They're taxed every year. The interest is taxed, right? A step up is going to be tax deferred assets, meaning this is your pre-tax accounts we've been talking about, IRAs, 401ks. They're going to be taxed when we take a distribution, and you're going to be paying tax on the money you use that year, that tax year. And then to the right, our most tax efficient money, and we've kind of already talked some about that, as a Roth IRA. It's forever growing tax free. I'll usually want to be most aggressive and put out further in the timeline the money I can, because that's great money to use later, or it's some of the best money you can pass to beneficiaries, surviving spouses, kids, whatever, anywhere that money wants to go. A lot of times you're penalizing the people you care about by not getting it dealt with in your lifetime too. So where do we put the assets, right? So money I need to spend or plan to this year, you have some reserve and savings. A lot of times what we're trying to do with the income planning, one way we can get rid of this pre-tax money is to spend the money the other way, meaning if I need $5,000 a month to do my retirement, we can spend that out of our pre-tax money first, because I need to get rid of it and not grow the problem and create a bigger problem down the road. The second way we can deal with that pre-tax money is convert it, right? So I can convert it to a Roth. Now, when I say smart conversions, what we're looking at is we want to do the analysis is what is the opportunity, the cap that we can convert up to? What do I need for income? And then what's the room in between? And that's your opportunity for Roth conversions. And again, it is a big deal when that 1231 goes by and we missed the opportunity because we missed shifting a piece to better tax treatment. The problem's growing. So we really want to address that. And then again, we're positioning the growth assets, the most aggressive pieces, further out in the timeline. And for many of you that have conceptually built the planning around a bucket plan, it's simply a conceptual model of the timeline, right? You have your liquidity reserve in bucket one. That's usually that next year of things that we know we're planned for. We have our income plan in bucket 2, which is the next section of the timeline. And we have our growth and strategy to where we're positioned for more aggressive growth and strategy longer in the timeline. And when we had the conversation recently about what's going on in the market, we talked about when the market was doing crazy things and when it does do crazy things, when you're structured like this, you're built for that, right? And all the media, all the news, all the emotion going around, guess what? This plan doesn't change. It holds up because you've built a good market cycle, 10 years or so, that gives the market time to get higher average over a period of time. It's almost like buying back 10, 15 years of your life because we weren't near as concerned about volatility maybe when we were 55 or 45. But the tax, where we put the money and how it's taxed is important in the timeline. And that's a question I have for some of you. Have you really put a lot of emphasis on asset location? I'm curious because it's not talked about near as much as more, what is the blend of stocks to bonds? What's the asset allocation? Anybody here really put some focus on that? Okay, I really strategically have put this kind of asset here. I'm spending this kind of asset and I'm growing this kind of asset. Why it's important in retirement? Why do we keep talking about this? We've kind of hit on this. While we're working maybe up to our 50s, early 50s, our job is to save, spend less than we earn, save, accumulate assets. And I find a lot of people have done a really good job with that approaching retirement. And we get there with a lot of puzzle pieces, but now we're shifting to retirement planning distribution phase. And we, a lot of these credits we no longer have, mortgage interest deductions, if we don't have the mortgage anymore. We're not adding to 401ks. These things change. Social Security, RMDs, Medicare, those things are coming up as far as decisions. And when we're doing our working years, really our focus is on one thing: save assets. So we have tools to work with when it comes to later to live the rest of our life the way we want to. Now, when we shift, this is why I said it's really important to make sure we're getting the right support addressing the five components of a successful retirement. Because in retirement, we need to know our after-tax savings before retiring, meaning what I was talking about. You don't have $1 million in that IRA. You really probably have $700,000, $750,000 that you can use and spend. Let's get clear on that because that's the real number. We need to start working on shifting money to prevent problems, funding our Roths or converting to the Roths, optimizing Social Security. A lot of you have heard me teach and talk about Social Security a lot. A lot of times by just claiming the right decision, it's $100,000, $200,000 shift of lower tax, cost of living adjusted income people are getting from Social Security by spending a little more time, going through a process and knowing the rules. RMDs, the required minimum distributions we talked about. If we don't plan on that, it bites us, right? If we're forced to take money we weren't planning on, or it sneaks up on us, and we have other sources of income, we're setting ourselves up for penalties, fees, extra taxes. Again, those are the things people don't want in retirement. Question. All that brings up a question. Does anybody here think taxes, or what do you think? Will taxes be higher or lower in the future? Any feedback? Taxes be higher or lower? Yeah. Yeah. 100%. Yeah. Now I'm getting higher. The reality, we've talked about some things. The current tax rates are supposed to sunset next year. Excuse me. But it looks like we'll have that extended a couple more years to work with. And there's been some talk of some reduction of certain tax areas, but that is a very temporary fix. Meaning if we're talking about in the future, 3 years from now, 5 years from now, much less 10, 15 years from now, taxes are going to be higher. Right? So why do I bring that up? As much as we don't like paying taxes and we're doing what we can to navigate it, I want to show you this. Oh, here we go. If you're looking at the history of tax rates in the United States, what you're going to see over here towards the end, we're in some of the lowest tax rates, federal tax rates in the history of this country. So As bad as it is to have to pay tax, it's been much worse and it's likely to get worse in the future. So while we have opportunities, while we have windows, while we can control the tax we pay, meaning if we do this work we're talking about now, we can pay the tax now at the rate we know versus grow the problem and pay the tax at whatever the government decides the rates are going to be in the future. Now another thing is this, how do we plan for the certainty of uncertainty? When we're building out a plan, one thing we know is that part of what we have to plan for is that there's things we're not certain about. We have to plan for the certainty of uncertainty. But we start looking at how do we start addressing that? I like this kind of Venn diagram here, things that matter, things we can control. Okay, things that matter. What will move the needle as much as anything in your retirement planning is this proactive yearly tax planning. Things we can control, right? We can do that. We can choose to be proactive. We can choose to say every year, I'm going to go through a process. I'm going to look at the opportunity and I'm going to pay the taxes now that makes sense to have a longer term tax benefit or pay less taxes over my life expectancy. The couple examples I was talking about from earlier today, we were really pretty much, both of them were looking at from 65 to 75, doing the Roth conversion up to a tax threshold. And then you immediately see you paid a little more tax in that 10-year window, but for the rest of their retirement, they were paying less tax and they were staying under those out of harm's way from the RMD traps, from the really high taxes as longevity sets in. So proactive tax planning is one of the things we can control. And I spend a minute speaking about that because there's so much, again, all this stuff in the media, all this fear-based emotional things to get response. It can use up a lot of our bandwidth and our energy. But let's make sure we're controlling the things we can control that are going to help our results and our output. So tax planning. And most people aren't doing it, but I'm here urging you, make it a priority and say, I'm going to make that part of my doing taxes is not doing tax returns. That's looking at the history over the last 12 months. And typically somebody's trying to get the lowest tax bill that year. We're talking about looking for opportunities to pay the least tax over you and your family's life. All right, let's get into this. So the tactical strategy, if you're here and you have the buckets of pre-tax money, and I know I've been hammering, I've been excited. I've had some really good scenarios and people really committed to working on this. And when I see that the outcomes and the results that will come from this work, it gets really, really exciting. So why do I spend so much time talking about a Roth? Roth in retirement, there's a lot of things beneficial that could help you in retirement. Number one, it could potentially reduce the tax you pay on your Social Security income. The reason that is if we have a bucket of Roth IRA money and we can take a distribution, it could reduce the provisional income number, which is the income number that's going to determine how much of your Social Security benefit is taxable. Okay. If that's something you're interested in, let me know. We can get that calculation. But the goal is if I have most sources of income, you're going to have wages, interest, dividends, and half of your Social Security added together create that provisional income number. One source of income that does not count towards that number that's applied to the thresholds of how much it's taxed is Roth IRA distribution. So sometimes if I was going $15,000 a year over a threshold to pay 50% of tax on 50% of my Social Security benefit versus paying tax on 85% of it, I could take enough of a distribution from a Roth to get me under the threshold. If you do that over long periods of time, that's significant tax savings on your Social Security. Number two, we just talked about this. Taxes are going to be higher in the future. So once we get, and some of the urgency is not just the RMDs at 75, is once we get that money shifted, it's protected from future tax increases. And I would dare to say certain future tax increases. The third thing, we talked about the tax trap of the RMDs, the required distributions. For everybody here, it's going to be sometime between 73 and 75. Once it's shifted from the IRA to the Roth, you're not dealing with the required minimum distributions. So that money can grow tax-free until you need it or until you pass it. Number four, we're going to talk more about this in a minute, is sometimes you punish a surviving spouse if we haven't dealt with the pre-tax money and they inherit big buckets of pre-tax money because it's more cumbersome and it's higher taxed money for them to use once you die. So we want to pay attention to that. We'll talk more about that. And then beyond that, sometimes your kids, they're going to be in a higher tax bracket, much less 20, 30 years down the road. And if we do some of this work now, your beneficiaries are going to get more use of your money, or your legacy is going to stretch longer. So a lot of reasons the Roth IRA can be beneficial and helpful in retirement planning when we've done the work. And a lot of times I will describe it like it's chopping down a tree. Every year, what's the opportunity? Oh, $40,000 conversion this year. Okay, let's get that done. Next year it's only 20 because we had some unexpected income. Okay, let's not let the year go by without doing the work. And if you do that for 6, 8, 10, 12 years, we typically can get ahead of the situation that where the problems and the penalties are going to come into play and put you in a much better situation tax-wise for the rest of your life. I'm talking about pay tax on your terms, not the IRS. Today, we know the tax rates we're dealing with. If we wait, we're waiting for the inevitable higher taxes, and we have no idea what that'll be if we just grow this money. And it's not that people are saying, I bet tax rates won't be higher. Usually, we're just getting busy with life. We have careers, we have kids, we have grandkids, and we just don't get around to it. And like I was saying earlier, a year will go by, 3 years will go by, 5 years will go by, and all of a sudden we haven't done the work, and the assets grown, the pre-tax assets grown, and the problem's gotten bigger. Again, I'll say it one more time. Don't let 1231 go by from this point forward to at least see if there's an opportunity to do some tax work. Yeah. You can convert over time. We talked about that, the smart planning. You're not going to convert $1 million IRA to a Roth because you'd be paying maximum taxes on that. You want to do it smart and stay within your limits, model the scenarios and make sure you're doing it intentional, and whatever tax bill it generates or any thresholds you might be exceeding that you know, and there's not surprises. That's what the smart conversion strategy really looks like. More control for you, less lifetime tax once we've built that Roth bucket. Let me check for questions. I've seen some things popping in the corner of my eye here. Let me see. I see higher, higher, higher. I do see that. Let's see. Do we have any questions to check at this point? I'm seeing some interaction here, and you see anything? But I'm not seeing the question itself. And did you have anything?
No, I don't know.
Okay. All right.
But they should be dropping them off in the question and answer box. The chat box will be disabled, but we can still see the questions in the question and answer box.
Okay. Yeah. So if you have questions or comments as we're talking through this, put it in the Q&A box. As we keep going through this Roth conversion strategy, one of the concepts is this idea of this mentality of let's do the minimum, pay the minimum tax we can in the year. And when we talk about more of shifting to a maximum mentality is saying how far up, if I'm in a tax bracket or I'm close to a tax bracket, like a 22 to a 24%, it's not a big shift. Can I use up the tax bracket I'm in, right? And really looking, that's part of the opportunity. Can I use up or fill up the tax bracket? Think, how much could be withdrawn? What's the opportunity? And if you're in the 12, 22, 24, and we'll be looking at the IRMA, the Medicare surcharge areas too. But think, how much can I utilize? How much can I take advantage of? How much money can I shift at today's lower tax rates? It's never going to be cheaper than it is this year. One of the things I want to say too about that is a lot of times I have somebody say, well, what about when I'm in a lower tax bracket later? One thing I'll say, I've seen it occasionally because I have hundreds and hundreds of scenarios, but it's less than 5% of the time do I see somebody in a lower tax bracket once they stop working. Most people's income and expenses, we're just replacing it with other sources of income. An opportunity that comes up. So the volatility is happening, or the market's down 5% year to date, or a couple months, we get some announcement about legislation, and there's another, the market hates uncertainty, right? And there's another 10% drop, a 20% drop even. If we built the timeline the way we described in the bucket plan or in the timeline strategy, and we have the time, it's actually a good opportunity when the market's down for us to start shifting that conversion. Here we go. If the market's down 20%, I can shift the same amount of assets over to the tax-free forever bucket with all those benefits we just looked at a 20% discount. The only assumption we have to believe in is that over time the market does come back up, and I think most people do believe that. So remember, good times, bad years in the market, every economy, every market, there's some opportunities, and we want to make sure we're controlling what we can control and we're taking advantage of those. Talked about that by the dip. For a lot of people, especially if we have a pretty fixed income for the year, once we identify the goal for the year of the conversion number, one of the things we can do, especially in a volatile economy like this, is we could say, okay, let's do a third of it now, and we think it still might be volatile, might continue to drop. We can do a third of it, and then later towards the end of the year, do the last piece of the conversion. So you can kind of dollar cost averaging and get the benefit of those lower days or lower months or lower weeks in the market. So just remember that down markets, it's a good time to say, wait a minute, do I have money and conversions that need to happen? Maybe this is one of my better opportunities to look at that, or I can do more. Yeah, don't waste a low tax bracket. And we talked about that. We can phase it out. So any questions, any thoughts about a Roth conversion strategy? Is anybody here doing that? Anybody here? Because this is when we're talking about areas of a successful retirement, we want to be at 8, 9, or 10 in those 5 areas we talked about. And an 8, 9, or 10 in tax planning is every year, we upload our tax returns, we do an analysis, and we're looking for any opportunities to either do Roth conversion planning. If it's after-tax money, the equivalent, a similar equivalent of that would be tax loss harvesting, meaning you're offsetting gains and losses in after-tax accounts. If we're doing those things every year, I'd say you're a 9 or 10. If we're looking at this and say, no, I need to do tax planning. I know it's important, but I haven't really got around to it. It might be a 3, 4, or 5. So it's a good question to ask. And I'd love to hear from you. Is anybody a thumbs up or they're currently doing this yearly tactical Roth conversion strategy? Yeah. All right. I have a question from Laura. Anna, I don't see it. Will you read it to me? Let me see. Here we go. Actually, I did.
Okay, awesome.
Yes, Laura, we're going to talk about that next. You are queuing me up. Laura asked, are you going to be talking about circumstances for someone who's already lost a spouse? And what the next thing that's coming up is what happens when a spouse dies. And we're going to talk about that. And if there's anything specific that we're not answering in the conversation here, Laura, pop in there, please. Marcia, I'm getting back to some questions. I'm going back. Software available to help an individual make a decision about how much to shift to a Roth. There are, but Marcia, I know you. Yeah, pop in, and I'll give you some good resources on how to model that. And because you have to be careful sometimes with online calculators, depending. Sometimes they're worth what they cost, especially, yeah. So pop in and we can run some scenarios, and I can give you some resources and direct you on how to really model. What is that cap? What are the thresholds? And if we're looking at smart conversions, what would that look like for me or for us? All right. Bill, should conversions be completed before required minimum distributions? Bill, great question. So remember, we're talking about in the 2 cases I was working on today that were huge, big impacts by doing this tax planning. We were working on it heavy between 65 and 75 because we wanted to, we're preventing the problem of the forced RMDs driving up penalties and unneeded money and extra taxes. So does it all need to be done before required minimum distribution age? Doesn't have to be. But most of the time, your heavy lifting is going to be done in those years leading up to that, because that's where, when we look at it in a timeline, you'll see it'll look like a cliff. Because when you have Social Security, maybe two in the household, maybe there's a pension, and then you have this required minimum distribution that's forced, you'll have it look like a cliff on how it can drive up the taxation in the household at that point. And once it's there and not enough work's been done, it can be hard to get rid of. We can have those penalties for a long, long time. So the goal is to do what work you can. Now it might be, okay, we're in the middle of or we're in the 24% tax bracket, right? That's where we're living right now. Can we go to the top of that? Yeah, it's not going to be cheaper to do it later, even if you drop down some, because the 15%, the 12, 15, they're going to be shifted up in the near future. So yes, but to also answer that question, you can still do Roth conversions after you start your required minimum distributions, because there's still, say you still have a couple $100,000 in IRAs, and you want to keep transitioning that either for a surviving spouse one day, for beneficiaries, or for you to have tax-free money later. We can continue to do Roth conversions, but typically the heavy lifting is in this window, 6, 8, 10, 15 years leading up to it. We can get the work done. So hope that answers your question, Bill. If there's a follow-up, ask. Let's see, Lisa, I do have Roths, but would like to look at converting more IRAs. Lisa, great. Usually when somebody sees the flexibility and the benefits of this, we just need to go through, and I'll show you exactly how we'll do this, is we need to go through a process. We need to model it, and we need to say, here's your area of opportunity. Here's what the tax would be to convert it, because we do pay tax on the amount we convert, but we're choosing to pay it now versus, again, at an unknown rate in the future. And the biggest roadblock is just getting busy and letting the year slip by. And with conversions, as we talk about this, it has to be submitted. It has to be processed by 12/31. It's not April 15th like a contribution. You can put your $8,000 in up until April 15th, but a conversion, we can convert any amount from a pre-tax account to the Roth, but it does have to be processed. We're not going to be able to submit it the day after Christmas and have a good chance of it being processed in time. We've had that happen. So any other questions, any follow-ups? Charles, can you transfer from an IRA to a Roth without paying tax on the transfer? Now that would be the too good to be true, right? Now, so what we're choosing is saying, would I rather pay, say 22% tax on $50,000 today, or wait 10 years and pay a higher tax rate when it's doubled to $100,000? So we're really paying attention to the impact of what we do today on the long-term lifetime tax that we'd be paying. Pete. All right, Pete, I love it. We're going to talk about being proactive. Pete says, I already have a meeting scheduled in June to get the ball rolling. I look forward to it. Right? And again, it's just, and I know Pete, and I know he's proactive, and it's just every year with the opportunity. It's part of what we do. It's our money. It's the people I care about. It's our future. And let's not give it away to people you don't want to give it away to. Anonymous, I'm 68. Am I too old to start the conversion? Absolutely not. Right. Your required minimum distributions will start at 73. So that means you have 5 years, and you have a window too where we're still, while these tax brackets haven't sunset, we have a window of lower tax brackets to start doing some of those conversions. So with a 5-year window, I would be very serious about this. This is crunch time. It's like, really don't let 12/31 of 2025 get by without seeing, is there an opportunity for me to do some work? Because if we don't, and we've already seen it, another year goes by, the problem's just grown. So great question, but no, I'd absolutely look at it. And back to Bill's point, even if you've started taking your RMDs, we can still do conversions. It's just the same thing. There's not the urgency that we're running up against this wall of potential penalties. And again, paying tax on money we don't need. That's not a good situation. And you have to pay tax on that money you don't need, even if the market's down. Good questions. I'll check back in. Now I kind of got the view of that. Anybody, let me ask this. I just want a yes. Anybody, as we're hearing this, anybody getting a little motivated to be proactive with this, and anybody buying in with me? Let's not let 1231 go by without at least checking on the opportunity, potential opportunity to put myself in a better tax rate. Thank you. Yes. 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 This will move the needle more than any investment choice. This tax planning will move the needle more than most things that the focus on the things that you can control and that matter. This tax planning, and most of the time it's not done. Right? If we'll do this work, you'll keep more money, you'll use more money, and you'll give more money away to people, to the government. I'll just say it. All right. So let me transition. Yes, 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 yes. I love it. All right. No no's. I don't see anybody saying they're not proactive with this. So what happens when a spouse dies? So somebody asked earlier about a survivor. What happens with a survivor? Unfortunately, there's some things that stack the deck against someone when a spouse dies. And it's especially bad because if we're not aware of what happens, the majority of the time, there's not a plan in place for when a spouse dies, although it's going to happen. Right? So let's look at this. One of the things that's going to happen, and this is true across the board or on average, income drops by about a third when we lose a spouse. And why is that? Usually a Social Security is going to drop off, maybe a pension, maybe there is some income still coming in. Income on average drops by a third when a spouse dies. It's just not things we necessarily think about and plan. In relation, expenses don't usually change that much when a person dies. Usually our bills and our lifestyle is pretty similar. So income drops. Talked about the Social Security. And then we talk about this idea of you'll hear it called a widow's penalty. It's actually a term. And it's when after the first hit of a drop in income, now that surviving widower is paying more in taxes or paying higher tax or has a higher tax burden. Why? They went from the most favorable tax bracket married joint to the least favorable single. Their standard deduction just got cut in half. Now, here's where we get to why do we want to do this Roth conversion planning work if we can, if we're in the time and we can. If this surviving spouse inherits a lot of pre-tax money, it's much more expensive for her or him to access and use than it was when both people were still here, right? Because of the higher tax burden, higher situation. So sometimes a reason to do this is because we want our surviving spouse to have more income and more money once we're not here anymore. Kind of a provide and protect for our family and the people we care about. So this is why I talk a lot about when we're claiming Social Security, that with these things that are kind of stacking the deck against a surviving spouse, we need to make sure we're spending some time and we're really making the best decision we can with how we claim our Social Security. A lot of times, especially in a survivor situation, this is one where you can switch benefits. The only situation where you can switch benefits from I could take mine and then switch to my deceased spouse if it's bigger in the timeline or vice versa. But if you don't know that and you don't know those numbers and you don't know you have to apply for it, we'll often see scenarios where there's $100,000, $200,000 of lifetime benefit that people aren't getting because they don't know the rules and they don't know they have to claim. Unfortunately, you're not going to get a phone call or a letter from Social Security saying, did you know if you did this, you're going to get an extra $100,000 in benefit. You have to know the rules that apply to your household and make a really good decision. Slow down, find yourself in a survivor situation and make a good decision with that Social Security. Okay? For anybody here so far have a question about survivor benefits, what happens when a spouse dies? Anybody surprised that about the double whammy of the drop of income and the increase in taxes? Sometimes it's just awareness that, hey, this is what happens. And then we can say, yeah, we better have a contingency plan because there's not just a retirement plan we need. We need the plan as if things work out the way we hope. And then we need the plan for when spouse A dies or when spouse B dies, are we still good? Are we built to survive that? Certainty of uncertainty, right? All right. Any questions on that? We talked about we can help reduce the tax impact on the surviving spouse, help replace income, minimize surprise and stress during a volatile, vulnerable time. And there's nothing harder for me than getting involved. Every year we get calls from for surviving spouses, and when there wasn't a plan in place, we now have less options to solve the problems, to come up with solutions with. And I know the person that died didn't mean to leave their spouse in that situation. They just didn't get around to it. So maybe for couples here, if when I ask that, what's your plan for when one of you dies? The answer is, well, we don't really have a plan for it. One, no, that's completely normal. That's almost all people. And I ask everybody that I talk to that's a couple. But two, no, it might be the action item to take away from tonight. Let's start having some conversations. And tax planning can be one part of the plan for a surviving spouse. Other things could be life insurance. It could be identifying, sell this piece of real estate, liquidate this asset, but just leave that person with a plan. Off my soapbox. Yeah. We start the earlier Roth conversions that can help get more of the shifting done. Yeah, optimizing Social Security. The last thing here, I covered all these talking, is just making sure to, this is another thing, to be an 8, 9, or 10 in estate planning, one of the 5 components. And in this tax planning class, it's one area of the 5 that we cover, but estate planning is another one. And make sure those estate planning documents, either they need to be done or they need to be updated. Talk to families all the time to where it was from Chicago or it was from California or it was from Florida 20 years ago. One, we need to make sure the language is intact. We need to make sure, the beneficiaries are still the same. The kids are probably grown now versus being kids. You might have grandkids. Make sure things are current, because that not being buttoned up can be another thing that really impacts the money that a spouse receives and helps that surviving spouse. So 3 big things we can do to help a surviving spouse. One, proactive tax planning. Every year, let's don't let 1231 get by without looking for the opportunity. Optimizing Social Security, making sure there's a plan in place to get the most out of your Social Security benefit. Right? For every household, that's going to be different. And then the third is buttoning up the estate planning. If any of those aren't a check, or I'm saying 8, 9, or 10, put it on your list. All right. If you want to talk about it or have a conversation, email, call, let us know. That's why we do this. We teach to say, okay, here's some awareness about what happens in these areas. And if we don't feel confident in it, let's have conversations about it. All right. Let's see. Going back to questions. Look at this interaction. I love this. Pete Torres, if a deceased spouse is on Social Security disability, can the surviving spouse take that benefit if higher? So if your deceased spouse, so they were on Social Security disability is what I'm understanding. I'll take it as that. If the benefit, well, so yes, you could utilize that benefit. You would need to be in the window. Got it. You would need to be in the window from age 60 to 70. And what you would want to do, Pete, you'd want to strategically take one benefit in the time. You want to get use of both benefits if possible. And the goal is to get the biggest benefit as big as possible. So say your deceased ex-spouse has a little bit smaller benefit. You could take that until yours was maxed out at 70 and say it's bigger at that point. Then we could switch to your bigger benefit the rest of your life. And your deceased spouse, basically, their benefit helped you buy or bridge the time to get an optimized benefit on you, or vice versa. Okay, so you can switch. So yes, that would still qualify because they still had the retirement credits, even if they weren't old enough to have switched to Social Security retirement, which happens at full retirement age. Okay, let's see. All right, anybody else? Questions on surviving spouse? Good. Yeah. So I have a couple people saying their takeaway, their action item is we're gonna come up with a plan for when one of us dies. Good. That's not necessarily the thing that comes to top of mind to talk about, but it's really important. Okay. And again, any of these conversations, I'll give you a bullet pointed template. If you just want some guidelines of how to start you're all welcome. A lot of your clients, you're all welcome to come in too, but okay, here's the 5 items to just start the conversation. Because sometimes it's hard to talk about things when you don't know where to start or don't know the process to go through. All right. We good so far with what happens when a spouse dies. Just know that for you couples, that's important. And for those of you with a deceased spouse, if you think there might be a scenario, we've had multiple scenarios where somebody had a benefit that they were entitled to from a deceased spouse they didn't realize was higher and could have switched. We had one recently, 78 years old, was eligible for a higher benefit from a deceased spouse since age 60 and missed out on that window, but got a big increase for the rest of her life from that point on. So if you're not sure or have questions, ask, reach out, let us know. Okay. Other things. So those are 2 big ones that apply to a lot of households, to everybody, single couples that worked in any kind of a setting with a 401k, the Roth conversion strategy. The second for you couples is, what is the plan for when we die? And are we both optimizing our lives and the life of the surviving spouse one day? Okay, helpful? Answer your question, Pete? Okay, and if it needs more detail, we can. Oh, okay, I got another one. Thank you. Do trust, been talking all day. Thank you for bearing with me. Do trust help or hurt retirement taxes? Okay, this is, we talk about trust, and in Georgia, one thing I'm going to defer a trust conversation to our estate planning attorney, but what I can say here without us going in doing a class, and I will do a class on estate planning and bring our estate planning attorney here, is that trusts are very different based on state law. There's a lot of trusts sold in Georgia that aren't necessary, and it's because attorneys can charge higher fees to do trust. Now, there are some trusts, if you have very specific wishes, you have a special needs child, you have a certain way you want your assets carried out with very certain specific directions, that a trust makes a lot of sense. So on the taxation of it, it really depends on where the trust was formed. If you're in Georgia now, I'm not sure in this case if this is someone local. But if you'd like to follow up that conversation, I can certainly circle up with Bill Rhodes, our estate planning attorney, and get specific on your state in that question. So there could be tax benefits as far as protecting or passing, but it really depends. I'm more concerned with than just saying that blanket for trust. Is it the right trust with the right language in the right state, accomplishing exactly what you want to? And I'll move on, but why I say that too is it's not uncommon. We'll have people bring in estate planning documents, and we'll have them sit down with the estate planning attorney and say, here's our documents and here's what we want to happen. And once it's reviewed, it's like, okay, it needs this language and this needs to be removed for it to do what you want it to do or what you think it's going to do. So, don't, if you want to have a one-off, email us with that specific question about the specific kind of trust, the purpose of the trust, and the strategy behind it, and we'll be happy to get you the answer there. All right. So additional things we can do. All right. Before we do that, anybody here, our couples here, anybody surprised at kind of the situation surviving spouses are in with the double whammy, the dip in income, the increase in taxes, and also the surprise that, hey, if we don't deal with this pre-tax money, it's going to be they're going to be penalized a third way. And then this is one that surprised a lot of people, the flexibility of a survivor benefit, that it's still the one benefit you can switch between your benefit and the deceased spouse. Yeah. Lisa said she's surprised by the increase in taxes for surviving spouse. Yeah, I would almost call it an epidemic that it needs to be addressed, because there's a lot of surviving spouse. There's some bad statistics of people that weren't in bad situations or approaching poverty or in poverty before a spouse died doing there because there wasn't a plan or circumstances led it there because of what happens. Okay. Other things. So this comes up this is for those of you, if you're here, and there's different strategies based on your age. I know a lot of you here, I see names, a lot of our clients give to church regularly. A lot of our clients have charities they believe in and support. Know that once you reach 70 and a half, one of the ways we can get rid of that pre-tax money, there's a third way. Before 70 and a half, we either need to spend it or convert it. Once we're 70 and a half, if you do your charitable donations out of your IRA, it doesn't count towards your RMDs and is not taxable. Right? So it's not taxable and it's not counting towards your RMDs. So it's much better at that point to take it from your IRA than to pay it out of your checking account because that money's taxable. That money was taxed for it to get there. So know that if that's you, or maybe that's even a parent, and they're donating money to any charity or church, and there's pre-tax money, this is one way to get a tax benefit. And ultimately pay less tax on that money, make the contribution. And of course, it's received tax-free from the organization. So qualified charitable distributions from IRAs come into play at 70 and a half. Before that, a couple of bullet points. You can do up to $100,000 from an IRA per person. It must be made out directly to the charity. The transfer of the check goes to the charity. It counts towards your RMDs, but it's not reported as income. So you get credit for the RMDs, but it's not adding to it. No deduction on the income tax rate. So QCDs also, there's another, the QCDs can help reduce that limit subjected to the IRMA or the Medicare surcharge too. So again, depending on how much you give, but I say if you give anything to charity, this is a smart way to do it if you have this pre-tax money to work with over 70 and a half. If not, just put it on your timeline that once I reach this age, this is another strategy we have in our toolkit to address taxes. If we're under 70 and a half and we're charitably inclined, another tool is called donor advised funds. And what that would be is say I give $10,000 a year to a charity. And there's a year I strategically need a bigger tax deduction. Maybe it's a bigger income year. I sold a property. With a donor advised fund, I could donate, say, $100,000 to a donor advised fund, get the deduction strategically the year I need it, and then give it to my charity of choice that I was already given to over a period of time as I choose. So it's a way to keep that charitable giving, but strategically in some situations get a much bigger tax break. Okay? So donor advised fund, again, for those of you that are giving anyway, these are where these conversations come up. Yeah. Not all rollovers are created equal. Anytime we do a rollover, just know you can do one rollover. And a rollover is when you take custody of an asset and we have 60 days to put it back into another IRA. If it's after that, the whole thing becomes taxable if we don't get it in the account. So ideally what you want to do is anytime you do money, when you have the opportunity, you're transitioning from one account to other, you want to do transfers. You can do as many transfers as you want to in a year. The trap that comes up with rollovers is one, you have to do it within the 60 days and it's strict. And the other piece is it can only be done once a year. Okay. So we've seen case studies where people unknowingly had an IRA rollover that they didn't realize was actually a rollover, and they did another one within the year and it blew up the whole thing. Okay. So just know when it comes time to transfer assets from account to account, make sure it's being done right. Make sure the paperwork's being documented. We had another case earlier this year to where a transfer was coded as a rollover and it caused some pretty significant, or no, it was coded as a distribution, right? A rollover was coded as a distribution. So be really, really careful when we start moving these accounts, or make sure it's buttoned up. This is one that comes up for those of you, if you worked in a company and you have highly appreciated stock. So say you were able to acquire some company stock at $10 a share. It's now worth $300 a share. Net unrealized appreciation, there's an opportunity with this. If you find yourself in that situation, you need to find somebody that knows what NUA is, and you have the opportunity to pay lower capital gains on that appreciation versus income. But it's very tricky and it's very nuanced. And I will tell you this, most custodians don't know about it or understand it, right? They're going to tell you that's not possible. They're going to give you information that's going to cost you more in taxes. So if you find yourself in a situation where you have highly appreciated company stock, and when I say highly appreciated, I mean it's doubled and doubled and doubled, right? It's one of those situations. No, there may be some opportunities to look at paying less tax on getting that out. Okay. 60-day rule, we talked about missing the deadline. Custodians, a lot of times custodians don't know the rules, especially with some of these what would be considered a little more nuanced or some of the advanced tax strategies. Okay, they're just not, they're not trained with some of this. All right, big point of this today is, I think for a lot of us, me included, I learned that you did your taxes at tax time, right? You do your tax returns every year. That's and we already did some context, right? That is very historical, looking back over 12 months and reporting what happened. What I want to challenge the thinking here, and a lot of you I know are already on board with this thinking or this mind shift, is that tax planning needs to be thought about all year long, 365 days a year, and it's proactively, as soon as we have information, tax returns, or a baseline from last year, we want to start mapping out what this year's going to look like. And we start putting some strategy together. We map out what we're going to do, when we're going to do it. That is the shift from reactive to proactive. And I'm going to get to that a little more. We talk about tax management too. This slide says it could save you tens of thousands, if not hundreds of thousands of dollars. Again, it's not uncommon. I know the examples I shared, the two cases I was working on earlier today, $1 million in tax savings, $2 million in tax savings. And some of you might say, I don't have $1 million. What are you talking about? That's crazy. That's not somebody else. Would it be beneficial to have $50,000 in tax savings over your life that you otherwise would pay the IRS, that you could use and spend $20,000 even, right? So the scale is irrelevant. It's that the work will get you and your household more money that you can spend. Here we go. So how do we do this? So we talk about, okay, it sounds good, Beau, but what's the process? And whether it's an optimizing Social Security process, any of the components, there's usually, we try to map out, okay, what's the steps, how to. Starts with, there's three things. One, as soon as your tax returns are done, they need to be uploaded. And we have software that will do this. And immediately analysis is started. Okay, what's the opportunity this year? And Marcia, to your question, I'm happy to do this for you. What's any opportunities this year? What's any threats? Or is there anywhere we're in harm's way that we're not seeing? And it starts giving us some real good information. And when we're looking, say we're looking at 2024's tax return, again, that becomes our base case. And then with conversation, we're making adjustments. Hey, you know what? I'm going to be making $10,000 more this year. I'm going to probably have right about the same dividends this year. Okay. So we can start mapping out what the year is going to look like, at least approximately, and we start putting plans in place. And then throughout the year, you're implementing and engaging the plan versus, again, I can tell you, I can see many times the planning doesn't come around. People start thinking about it in December, and then it's, we didn't quite get to it. And 12/31 went by and an opportunity probably went by. So number one, we need to upload the tax return, do an analysis on what are the opportunities, what are the threats, and one of the example of a threat is, are we unknowingly about to violate or in danger of violating one of the thresholds we don't want to? We're going into a tax bracket we don't mean to. We're triggering a surcharge we didn't know about. We want to avoid surprises, and that's part of the proactive. We talked about that. We analyze and look for the opportunities. That's the second step, and we discuss it. Right? We talk through it, and then number three, we'd sit down and have a conversation in person. Usually, ideally, if you're not here locally, we certainly do a lot of remote Zoom type of meetings, and we go through the conversation. Here's the opportunity. Now, ultimately, this is your money. That's your decision. I can help point out the opportunities and the gotchas or the potential issues that we might have. And say the opportunity, and what I mean by that, the opportunity is a $50,000 conversion. You might say, you know what? We feel good about doing 30. Okay. That's a lot better year than us missing this year. Right. So utilize the resource. Let us know if that's something. This is going to be relevant and helpful to reach out. If again, when we're talking about the Roth conversion in particular, you have buckets of pre-tax money, and we know that between now and required minimum distribution age, which is for everybody here 73 to 75, it's going to need to be dealt with. And so far, we really haven't been chopping down the tree. We haven't every year been looking and saying, okay, we did 20,000 this year. We were able to do 50,000 the year before. Looks like we're going to be able to do 40,000. You're getting the work done as you go instead of growing the problem. So a lot of times, if we can just know the process to go through, it's the catalyst to create the movement to get things done. Now, we talked a lot today about, this is the route. We call our planning process, we call it the roadmap to a rich life retirement. And what it includes, here's the visual. You've heard me talk about 5 components of a successful retirement, and we call it the route, your route to a successful retirement. And we'll be teaching on all these. We'll be bringing in experts to facilitate questions and learn more about this. It's one of the promises we make to our clients as we continue to teach and grow and evolve together with this. The risk management, that is the investments, the allocation of investments, the income plan, Social Security, sources of distribution, where does it come from, unexpected healthcare expenses, what we've been talking about a lot today, the tax plan, estate plan, and legacy. I wanted to go through that again because I challenge you, as you're looking at those 5 areas on the model, ask yourself, am I on a scale of 1 to 10, where am I? An 8, 9, or 10 says I'm buttoned up, I've addressed it, I feel really confident. A 1, 2, or 3 on the other end says, I wasn't even aware that was a thing, right? Or we haven't addressed it at all. I haven't addressed it all. And maybe a 4, 5, or 6 is we've done some work, but no, we need to do more. And the goal with this, and this is a self-assessment tool for you, is there's a good chance you might be an 8, 9, or 10 in a couple of areas, but a 2, 3, or 4 in others. And that gives you the agenda or the working to-do list of things to have conversations about. Okay. But I do want to really bring out that tax planning. If we're not doing it, that's one of the things that if we do it and go through the process, it will move the needle the most. And as you notice, I can't move forward without saying, at the very top of our model, there's no route. None of this matters if I'm not clear or we're not clear on you. What are your values? What do you care about? What are your biases? What are the things you dream of? What are we trying to accomplish? What does your successful retirement look like? And then when we have that context, then we have the ability to use your assets as a tool to go through this route process, get to 8, 9, or 10, have it buttoned up. And then ideally we're removing the worry or any anxiety around those areas of your retirement so you can focus on the most important things. Your assets are only a tool to most likely spend time with the people you care about the most, create memories and experiences, and ideally work on your health. Those are the things that will make you happier. No charge for that. I had a very famous psychologist share with me, the data backs that up. Those are the things you can spend money on that'll make you happy. And if we want to have more money to work with, proactive tax planning. Like this model here too, as we're kind of winding down, and I have a couple things to give away. Thanks for the engagement. Thanks for hanging with me. You can see I get excited about this because I feel that part of my purpose is doing this because the needle needs to be moved in better tax planning being available to people in retirement. Right? I think in a lot of the world, a lot of this country, good tax planning has been reserved to the ultra wealthy and not the mass affluent, which is a lot of times who we're talking to. So here's the model, right? We want to shift, and this is most of the population on the left. We want to shift from reactive, from the whole retirement planning to any aspect of that. And from today's conversation, certainly the annual tax planning to proactive. Okay. A reactive person's almost always going to have the highest lifetime tax bill and less money to use and spend for them and provide and to make an impact and provide and protect for their family. The proactive person that makes it a priority, that's going to be the key to having the lower lifetime tax bill and have more resources to provide and protect for their family and the people they care about the most. So I hope there was some good ideas here, some new awarenesses that maybe created some new action items, because my reason for doing this is to motivate anything that will get us a better outcome, a better result. Because I believe as we're doing retirement planning, this should be the best time of your life to do the things you've always wanted to do. And let's make the most, maximize, be the best stewards we can of the assets and resources. Now, to the good stuff. We're going to give away some stuff. Thank you for this help. Thank you, Marcia. We completed step 1. I guess we're already working on step 2. Good. Yeah. A lot of you that are clients, you're well on the route process. We're working through. And again, it's just a good self-guide. Do I feel like I 8, 9, or 10 in these? Check. If not, here's something I want to start talking about or working on. Things to give away for all of you. Thank you for hanging out. And I have the Ed Slot book here in just a minute. This is for everybody. We have some resources, some tools around this tax planning, RMD, some of the things we talked about today. We talked about the self-assessment. We have the 5 tax traps or gotchas in retirement, a little more going into that. And then 4 ways you can actively reduce your required minimum distributions. So if you'd like those resources, those tools, just call, you can text or email. Call or text 770-249-7424. That's 770-249-7424. Or you can email info@richlifeadvisors.com. That's info@richlifeadvisors.com. And I believe Anna receives that. We'll make sure this is mailed right back to you. Okay. Okay. And so for those of you, so let's do a participation engagement award. So this Ed Slot book, this man has taught me more about tax planning than anyone, and a great resource. A lot of you that are clients, we've used this book in our planning process. So the most engaged, we had a lot of engagement. Okay, good, Lisa. Give him a hard time for me. A lot of good interaction. I don't know. This is tough. You know who I think was the most active, Anna?
Go for it. Yeah.
I think we're going to have to give it to Pete Torres. So Pete, I don't think you have this book, do you? All right. Okay. Good. All right. We'll get that in the mail to you. Unless you're stopping by soon, I'll just leave it at the front desk. But thanks for all the engagement. Thanks for the feedback. Again, hope this was helpful. Insights, ideas, hopefully move to taking some action, because that's the only way we're going to do things different. And we're here for you. If you have questions, again, here's the contact information. You need anything from me or our team, 770-249-7424, info@richlifeadvisors.com. If you have questions, want to type out some bullet points to a scenario you want us to address, we'll be happy to help. So we have other classes coming up throughout the year. We'll make sure you're notified of other topics, other speakers we might. Okay. You got it, Pete. Pete's going to pick it up at the office, Anna. Leave it in his file. Let us know how we can help. And if there's anything today that we didn't talk about or could do that would be more helpful, let me know, because we want to make sure that this time we spend together is valuable for everybody. So again, thanks everybody, and I will talk to you soon.